Sarah?
Yes.
Yeah, sorry, it's Pete Mitchell. Sorry.
Hello, Pete. Sorry.
If people have their cameras off, all I get is initials, and sometimes those initials don't seem to match the initials of the people.
Like I'm trying to persuade people to put a photograph up because it's so much easier to see who they are.
I mean, like John Fitter, for John, all I get is JC, which
yes,
so it's hard for me to work out who these people are.
Yeah, it's because he's on the system as Fitter John Councillor, and it picks up the last two words thinking they are your surname. So
Right.
Sadly, we haven't actually been able to resolve that with IS, which is why we're trying to encourage members to put a photograph up.
Right, okay, that's great. It's just when if all I see is JC, he wants to talk, it's difficult for me to work out who that is.
Yeah, if you look in the chat box, Pete, it will actually come up with their name. So it also see their way. Yeah, if you look in the chat box, it will actually say John Fitter at the top of the box. So we'll have the initial JC next to it, but it will say John Fitter.
Okay, that's great, Sarah. Thank you.
Chairman, I'm just going to see if there's a problem with the live stream. I'll be back in 2 seconds.
Thank you, Sarah. Pete, I'm one of the defaulters on this also, so I must put my photograph up.
Okay. As long as the name comes up the top, Derek, I'm okay with that. But it's just when you get initials and they don't seem to refer to anybody. And if I said to you, JC wants to speak this near Christmas, you might think it's
yes,
calling.
I'll bring him on first anyway. So.
Yes, yeah, put him to the top of the list.
For the benefit of the committee and members listening, I'm going to call a comfort break after 1 hour at 11 o'clock, and because some of us have been on for a couple of hours anyway, hour and a half anyway. So, Lynn, if you could remind me of that point.
I'll try, Chairman.
Chairman, the live stream is live. You may start the meeting.
Good morning, everybody. Welcome to this virtual meeting of the Pension Committee. Before consideration of today's business, I will outline the protocols for the meeting. Today's meeting is being live streamed to the public and is also being recorded. When members are speaking, they may choose to use their video, but we would prefer it at other times that they don't. If the council's live stream fails during the meeting and we cannot share the proceedings, I will adjourn the meeting so that access can be restored. If the issue cannot be resolved, I will halt the meeting, and remaining business will be conducted at a future date. If a member experiences a technical issue, I will adjourn for a short period while efforts are made to re-establish their connection. As I call members to speak, I remind you to switch on your microphone. If for some reason you cannot be heard, the Democratic Officer will advise you. Members of the Pension Committee who wish to speak on mic and declare an interest, raise a point of order, or be experiencing a technical issue should indicate raising in the chat box, which is being monitored by the Vice Chairman. Any members present who are not on the Pensions Committee who wish to ask a question should also type an X in the chat box. The vote will be taken via roll call and the result announced by the Democratic Officer, who is Lynn this morning. When the press and public are excluded from the meeting, members will be required to, in turn, to confirm and declare there are no other persons present who are not entitled to either see or hear consideration of the matter. When a Pensions Committee member has declared a non-registrable interest, a disclosable pecuniary interest, or an interest by virtue of any trade union membership in a matter, they must leave the virtual meeting. Their departure will be confirmed and they will be invited to rejoin the meeting at the appropriate time. If a Pensions Committee member needs to leave the meeting before it is concluded, they should indicate this in the chat box, and the Vice Chairman will advise myself and the Democratic Officer. Okay, Lynn, could I pass over to you to confirm the members present and state their electoral divisions, please?
Thank you, Chairman. I'll now call your name. Please could Cornwall Council members confirm your name and your electoral division, And could co-opted members please confirm your name and whether you represent employers or employees. Starting with you, Chairman, please. Councillor Holly.
Yep. Derek Holly, Councillor Saltash East Division.
Councillor Fitter.
John Fitter, Cornwall Councillor, Colin, St Morgan and Newquay North.
Councillor Harris.
David Harris, Truro to Haven.
Councillor Hurd.
Councillor Hurd, Camborne, Pendarvis Division.
Councillor James.
Sue James, Councillor for St Justin Penwith.
Councillor Kenny.
Good morning, Councillor Joanna Kenny, Newquay Pentire.
Councillor Kirkham.
Jane Kirkham, Councillor for Falmouth Smithick.
Councillor Mitchell.
Pete Mitchell, St Agnes, Blackwater and Mithian.
And Councillor Monk.
Councillor Monk, Newquay Traralgon.
Andy Stott.
Andy Stott, representing employees.
And Chris Wilson.
Chris Wilson, representing employers.
Thank you. I can confirm the following local pension board members are also in attendance: Katie Dalsgaard and Amanda Trowell. And the following officers are also in attendance: for Cornwall Council's pensions team, Matt Allen, Employment Liaison Officer, Russell Ashman, Head of Pensions, Treasury and Technical, Matthew Chapman, Assistant Pensions Investments Officer, Matt Davies, Assistant Pensions Benefits Manager, Sean Johns, Pension Investments Manager, Melissa Kelly, Pension Fund Accountant, and Calvin Matthews, Pensions Benefits Manager. For the Systems Development Team, there is James Poole, who's the Systems Team Leader. And for Democratic Services, there's myself, Lynn Beardsmore, Democratic Officer, and the meeting producer, Sarah Goodall. Our external officers today, fund advisors, are Aniket Badouri of Mercer, Kieran Harkin of Mercer, John Finch, who's independent. I don't think you've got Julie West of Hyman's Robertson. And for the Brunel Pension Partnership, we have Chris Crozier. And that's the roll call completed, Chairman. Thank you.
Thank you very much, Lynn, for that. And we'll move on to the meeting. Let's get started. First of all, apologies for absence, please, Lynn.
Apologies today from Nick Olgard and Councillor Wood.
Thank you very much for that. Are there any declarations of interest? No, no declarations of interest. Two things to say first. First of all, welcome to new members. That's John Fitter. And you're very welcome to join us, John. And we're looking forward to your help and advice in the future. The other announcement is congratulations to all our pensions team for the LAPFA award from last week. Sean, can you just briefly say where you had, what you attended and what happened?
Yeah, thank you, Derek. I attended the LAPFA Awards ceremony, as you said, and the fund won the LGPS Fund of the Year under 2.5 billion, and we were also shortlisted for the approach to sustainable investing as well. So, we were all very pleased to have, won the award and been nominated for the other one. Thank you.
Yeah, thank you. And Brunel will also successful in different categories, so that's really good for all of us. Thank you, Sean, for that. And so a welcome to you all, a welcome to the Pensions Board, Katie and Amanda, who are here today, and to our three Matts and Melissa. And you're always welcome to join and listen to us and give us your advice as well. Okay, let's get started with the minutes of the meeting. Are there any comments on the minutes of the meeting first of all? There being no comments, Lynn, can you take the call?
Sorry, comment from me, Derek.
Sorry, go on then, Sean.
Yeah, thank you. It was just to make the committee aware, because we discussed it at the previous meeting, that we've now published the annual report on the website, which had a deadline of the 1st of December. However, unlike previous years, we've had to publish it excluding the external audit report. And the reason for that is that external auditors haven't signed off Cornwall Council's accounts and a number of other accounts for different local councils. It's not just Cornwall Council, it's a bit of a national issue. What we've done is, for the pension fund, we've published a statement to say that it is missing and that we'll republish once it's available. So we will do that once Cornwall Council's accounts is signed off. Thank you.
Thank you for that. Back to Lynn.
Thank you, Chairman. This is the roll call for the accuracy of the minutes of the meeting. Please say whether you are for, against or abstain. John Fitter.
Abstain.
David Harris.
For.
Sorry, Chairman, we haven't had anybody propose or second it yet.
Oh, sorry, I'll propose it from the chair and I hope someone will second it.
I'll second it, Derek.
Thank you very much, Pete. Right, proceed.
Thank you.
Sorry,
John Hurd, no worries. John Hurd, for, against or abstain. Thank you. Councillor Holly.
For.
Sue James.
For.
Joanna Kenny.
For.
Jane Kirkham.
For.
Pete Mitchell.
For.
Oliver Monk.
For.
Andy Stott.
For.
And Chris Wilson.
For.
That's unanimous, Chairman. Oh, sorry, beg your pardon. It's carried with one abstention.
Thank you very much indeed.
Please, Mr. Chairman, just to note that I was obviously not present and I felt it's not important for me to
Yeah, thank you for that clarification, John. That's fine. Item number 4, which is on page 9 of your agenda. The update on investments, please. Russell.
Thank you, Chair. Before I actually launch into the report itself, I think a couple of comments I want to make. Firstly, this report is the first time we've brought our in-house performance report to committee. I think we've updated members previously saying we were working on bringing this in-house and producing it ourselves. In the past, we have relied on using Mercer to produce a significant part of the report. But we decided that we really wanted to take ownership of it ourselves, particularly as with the move to Brunel, it will change the way we operate going forward. So hopefully members will find the report useful, and obviously any feedback, probably not in the meeting today, but if you want to feedback to either myself or Sean on anything in terms of how the report's set out and detail and clarification or anything that's missing, we would welcome that. But as I say, hopefully members will find the report very helpful. In terms of moving into the actual report, if I move on to page 14, and you'll see at the top there the summary of the performance of the fund to the end of the third quarter of the calendar year, the 30th of September 2020. You can see that investments have continued to improve in the last quarter, up 26 million from where they were at the end of June. That's an increase of 1.2%, and that's a further increase of 198 million compared with the valuation at March 2019, which is the right-hand box. So obviously strong value of growth in the investments, particularly with the rather sudden reduction that was suffered in the first quarter of this year when the COVID pandemic hit markets very, very poorly. We saw sort of record sell-offs and record reductions. The recovery is continuing in terms of the value of the assets, and we're very healthily placed at 2.1 billion at the end of September. Liabilities in the last quarter have reduced slightly. They've reduced by 85 million. That's approximately 3.7%. In comparison to where they were when the valuation was done, they're actually slightly higher at 72 million higher, which is 3.4%. Overall, that means that the current position of the fund in totality is that there is a deficit at the moment of about £81 million. So we're about 96.3% funded. That's compared with the 192 million deficit at the end of June and the 207 million deficit when the valuation was done in March 2019. So in 2019, when the valuation was done, our funding level was 90%. We're now at 96.3%. And obviously the caveat there is that obviously markets have been very strong on the recovery since the COVID pandemic earlier in the year, and we've had, and as members will be aware, it's in the press on a regular basis, that in certain markets, global markets, we are now seeing record indices being posted on a regular basis. So the growth is very strong at the moment. Whether that growth continues, we'll touch on that in a minute, because I'll ask our investment consultants to come in a minute on what they think and how the markets will pan out in the next 3 to 9 months. Just finishing off this bit before I ask them to come in on that. The investment's over 20%. For the first time for as long as I can remember, Newton doesn't figure. We mention those every committee because we have a statutory obligation that we should mention any fund manager who's over 20%, but because we have now disinvested 270 million from the Newton Global Equity Holding and transferred that to the new Global Sustainable Equity Portfolio, they have now dropped below the 20%. So if anyone wants to know why they've dropped off. Obviously, as we carried on with the transition process into Brunel, they are now becoming obviously a significant element of our investment and will be either up to between 95 and 100% probably by the time we fully transition over in a couple of years' time. So obviously we have to mention that they are now at 44% of the fund. As I've already touched on them, a significant movement was a disinvestment from Newton's Global Equity Holding to go into that new Brunel's Global Sustainable Equity Portfolio, and it gives us a strong allocation there, and obviously it is the direction that the fund wants to go in. Some of the other movements, slightly smaller, mainly in the property area, that have now transferred over to Brunel for management, were the property portfolio from Aberdeen Standard, etc., and some of the internal management portfolios and property portfolios are now transferred over. So the transition is continuing. As I say, it will get up to maybe 100% or between 95 and 100%. It depends whether absolutely everything goes into Brunel. Those final decisions have been made in a year or two's time. In terms of specific performance, if you move on to the next page, again, it's a summary of the managers, just picking out some of the key figures that maybe jump off the page, and particularly in the 3 months, looking particularly at the 3 month performance since the last meeting, you'll see that Aberdeen Standard is down against the target. They've had a good 12 months, recovered well after the COVID issue, but there is a little bit of drag that they're getting at the moment with holding in an old shopping centre, which is causing performance to be down currently in the last 3 months. The Hermes figure, which looks quite frightening, slightly further down for the 3 months. Significantly, one of the reasons for that in the 3 month figure is that the way that State Street have been reporting that was overstating the position in previous quarters. That's now been corrected as Hermes have their own method of valuation every 6 months. Unfortunately, that obviously creates a disparity in this quarter, which means that the -6% isn't a real measure of performance, but it is correcting the overall position going forward. Wiltshire on the private equity, -13. One of the real reasons here is on the private investments, particularly private equity. The 3 month figure is really that there is a real time lapse on private equity and the private markets, how they feed in, and that is really as a result of probably true performance in Q1, when obviously the COVID pandemic hit. There is that sort of 1 to 2 quarter lapse in time on reporting. So overall, that is what's causing that 3 month performance figure. ETF, we've mentioned a number of times. This is a very old investment, and this is in the final throes of being wound up and finished. And obviously, during that period, there are a few losses that will be delivered, and unfortunately, minus 1.9 for the 3 months. Probably the other one mentioning on there, picking up on the reds in the period, is the BlackRock, the risk management framework. Just to say that we have, as we've said in previous meetings, now implemented part of the risk management framework, which is the equity protection. There are going to be other parts, including currency, which we will start introducing in the next quarter. The key reason why it's down in the 3 months there is that the risk management framework is the equity protection. The equity protection obviously works in a little bit in reverse of how the equity markets work. So there's been significant growth in the equity markets during that quarter. So you would expect the risk management framework to actually not perform so well. It's there as protection for when the equity markets go down. So if we'd have seen a significant fall in equity markets, then the risk management framework would have had a different performance reporting figure here. I think that's the summary of where we are in terms of the performance. I say markets, they continue to be strong. They continue to still be strong post the end of September for people that do follow the markets. And say some of the global ones, North American indices, you'll see that they are continually posting record numbers. But I think what I will do is, at this point, ask either Kieran or Annika to come in and maybe just give us a brief view of what they think the markets are like in the next 3 to 6 months.
Apologies, just before we do, there's been a couple of hands up for a while. I don't know if it'd be a good time before we move on. I think Joanna was first and then Andy was second.
Thanks, Sean.
Thank you. I was just about to say, can we ask some questions? Going right back to the very first slide, when you talk about the deficit being 81 million, as a headline figure, that looks absolutely appalling and could very, very much be taken out of context. So it would be useful, I think, to have those, because actually that's not bad. A 96% coverage is really quite good. But someone coming along who wishes to make political capital out of it would concentrate on that 81 million deficit. Can you assure us that this is not a bad position to be in?
Yeah, I can give you that assurance, Councillor Kenny. For those who have been on the pension committee any longer will realise that it wasn't that long ago, 2-3 years ago, that actually our deficit is very close to $500 million at 480 million. We've made it significantly improved since then. I think I won't repeat her words because I can't remember them, but the actuary, when Catherine is here, will say the surplus of deficit is not a really great way of measuring the performance of the fund. It is a snapshot in time. It's taking into account what all your future liabilities may be, and obviously as they go a long time into the future, some of the work that Hyman's do for us in the 3-year valuation is far more meaningful when you work out what is the probability of us being fully funded at the right time in the future. And those are quite good indicators, and they are showing that, you know, we've got a high probability of being fully funded at the appropriate time in the future. At the snapshot in time, yes, 81 million, but these numbers can move fairly dramatically with the way that discount factors are applied, etc. And I wouldn't give any concern with it at the moment, and 81 is the best position we have been in as a fund for a significant number of years.
I think it would be useful to actually have that, because this is a report that is public. I think it would be useful to have that quick assessment in narrative form, just so we don't get all this negative publicity which somebody might use. So I don't know, because this is an internal report, it shouldn't be too difficult just to shove in a sentence that actually. And coming back down to the performance of the investments, we've just been having a training session about how incredibly difficult it is to monitor infrastructure. So it is very difficult, I think, with all those infrastructure things to say it's a negative, it hasn't got where it is, but you can't tell. That is always been I love infrastructure, but it's very difficult to monitor on a 3-monthly basis.
Yes, won't disagree with that. I say the training gave you the insight into that earlier.
Thank you for that, both of you. Was there another hand, Pete? No, there wasn't. No.
It was Andy Stott had a question. He's raised his hand. Yeah.
Okay, Andy.
Yeah. Quick question. I was wondering why the liabilities had fallen somewhat between June and September. It seems to be counter the trend. I mean, I want to assume that for most schemes, liabilities steadily increase rather than fall back.
Yeah, I mean, I can answer that one if you'd like, Russell.
Yeah.
Basically, Andy, it's the way that it's calculated by the actuaries. So every quarter, the actuary basically flexes the discount rate and the salary increase in CPI assumptions. The discount rate, as you may remember from the valuation, is based on the probability of success of the outcomes that are 70%. So it's kind of what investment return are we likely to get with a 70% chance. And since it was done in June, obviously there's been a slight pickup in market sentiment, which is why the discount rate's actually increased from, I believe it was 3.5 to 3.7%, so by 0.2% over the quarter. So that's what's had the majority of the impact. The rest of the assumptions, the actuary keeps consistent with the valuation apart from those.
Thank you.
Okay, Jane?
Councillor.
Is it Jane?
Yeah, sorry, I can't make my thingy work. Yeah, I was just going to, before we move on to the next item, I was just going to say I looked at the page 21 about the responsible investment, which is great, and I noticed a bit about the share action and the Unison thing that they marked us a couple of years ago. It looks though that we've remarked ourselves using their criteria. Would it be worth us approaching them to ask them to remark us now that we've changed so much and we have our new RI policy?
Well, I'll come in first on that, and then whether Sean wants to come in. Obviously, I paused at the end of the performance. I was going to ask our investment consultants to come in about markets. I was then going to hand over to Sean to go through the RI elements in more detail. So I think if I nudge Sean and say, can you pick that question up when you do your presentation in a minute on the RI element?
Yep, that's fine. Thank you. Sorry.
David Harris, Chair.
David?
Thank you. 3 hopefully quick questions. Well, very simply, when we transition assets into Brunel, do they go across at market value? So when we see the Brunel performance, that's performance from the date they've taken them on?
That's right, yeah.
Right, that's question 1. The risk management framework, this is, if I remember rightly, this is our option strategy. So we covered when markets fall, etc. So looking at the valuation on page 37, there's £424 million in that. So what is that invested in?
It's gilts and cash at the minute is what's underlying it, and then obviously it's invested in options, which if you want more information, Annika can cover that.
No, that's what I think my basic question was. So this is the money we put up to cover margin calls, etc. And then my final question was looking at the valuation, 30th of June 2098 million, 30th September 2123 million. It's gone up by £25 million overall, but presumably some of that is new cash that comes into the fund from pension contributions. What's that figure?
Sorry, David, could you say that again? I was just turning to the right page.
Sorry, Sean. If you look at page 37, we've got total valuation at 30th of June of 2098 million. 30th September 2123 million. That's a £25 million overall gain. But some of that will be represented by cash coming in from contributions from employers and employees. What's that number on a quarterly or monthly basis?
Yeah, I mean, if I'm honest, it broadly tends to net off. I think from memory, we probably end up with circa 1.5 million every month, increasing from that, and that will be reflected in CC cash generally. It's just labelled cash on there. We used to get more, but Cornwall Council pay their fixed deficit of about 11 million in one lump sum at the start of the year. So because of that now, it almost broadly nets off.
All right, thank you.
Thank you, David. There are no more questions. Can we go back to Kieran and Annika, please?
Yeah, I mean, very briefly from me, Russell's done a very good job of summarising where we are today. I think for a 3 to 6 month outlook, which I'll heavily caveat is very difficult, as we all know, classic investment consultant sitting on the fence, but I think a phrase I would use is cautious optimism. So we have a number of variables in play globally across economics and markets, not least COVID, as we know, but we've got a new US administration on the horizon. Well, that may be mitigated somewhat by what could happen in the election to 2 Senate seats in Georgia in January. So if that leads to a Republican Senate, with clearly Joe Biden as president, the markets at the moment have received that split as reasonably favourable for different reasons. There's spending to be determined in terms of the next fiscal package through the US. You'll have seen figures this week of $916 billion floating around. That's still to get the go ahead, and that spending package in aggregate, if it does come through post the new president, may be lower than the market had initially thought, but still significant. But there are other optimistic signs, not least the green agenda from Joe Biden, potentially easing of international trade restrictions, etc. But that doesn't mean things like US-China relationship will repair itself. Far from it, in fact. I think there's still likely to be quite hawkish sentiment there. So there are some risks out there, but overall, from the US point of view, the biggest problem they have is clearly getting COVID under control, which Joe Biden has made a big target, and clearly that can have some short-term economic effects. But looking ahead, the vaccine position globally is positive. We've clearly seen the UK move quickly on that. A lot of the equity market sentiment seems to still be centred around that, but we should understand that when we still have fiscal packages and monetary packages from the big governments and central banks globally, so US, Federal Reserve, ECB, Bank of England, Bank of Japan, what that might do down the line to inflation remains to be seen. At the moment, it's having no significant effects in the short term, but if nothing else, it's been proven over the last 10 to 12 years to inflate asset prices. So if we just focused on the asset portfolio of a pension fund such as Cornwall, we do have cautious optimism that we still will see some good growth from a risk on sentiment. Clearly, real economy and the effects on the day-to-day position of the average person in Cornwall, wherever, that's a different issue, and that's a lot more micro than macro at the moment, but cautious optimism. I'll probably bring Annika in. The only thing I'd probably add is clearly we've got other issues such as currency, which we're addressing through things like the risk management framework. We've seen significant dollar weakness of late. We're still not out of the woods on the Brexit risk to sterling. So, these are risks as well, but cautiously optimistic, I think, on risk assets.
Thank you.
John Finch, Chair, please.
John?
Oh, yeah. Just a question, really, if I may, that you mentioned about the makeup of the present administration, or the proposed administration in America. And I just wondered if you had sort of thought about the appointment of Secretary of State of Tony Blinken. He's the person who's been nominated by Joe Biden. And of course, he is a very fervent European, and he lived in Paris for quite a long time. And he's made it quite clear, I think, in personal statements that he believes Britain's place is being part of Europe. And I just wondered if you visualised any difficulties with our trade relations with America if he does become Secretary of State.
I'm definitely going to sit on the fence on that question, I'm afraid. I wouldn't probably want to pass any judgment at this stage on the administration until it's really formed. I think my belief in politics being done in advance over the last few years have been shattered. I think you really just got to wait and see who plays out. And as I said, the balancing potentially of the Senate being Republican versus democratic president is an interesting issue, and I think there will be clearly some restrictions around how free a rein you can have, and that extends to international trade policies as well.
Very helpful. Thank you very much.
John Fitter, could you please not use the hand or do the cross in the box, because it's confusing. That was actually John Finch's question, Chair.
It's okay, I just go ahead with it. Yeah, please don't use the hand, it's a confusing symbol anyway, so if you can just put crosses, I'd be grateful. John Finch.
Okay, I was just going to make a comment to build on what Kieran was saying. The short term is hard to predict, but in the last couple of weeks we've had slightly longer term capital market assumptions reports from both BlackRock and JP Morgan, and they are showing historically equities would give you a return over government bonds of around 4%. But both of those surveys over the next 5 to 10 years are showing equities forecasting 5 to 6% above bonds, with bonds actually producing negative results. So I think economically, big organizations like JPM and BlackRock are very positive across most equity markets. And I think that's in the position of the fund, although we need to be cautious, I think we're well positioned, and with the RMF to protect us against the market volatility of equities, then I think that's good news. That we've seen in the last month, going back to Andy's question, bond yields rise a wee bit. Not much, but that has an impact on the assumptions in the liabilities as well.
Okay, thank you for that, John.
And Andy Stott, Chair, please.
Andy?
Yes, I'm quite. I've been following the dollar. It's continuing to. You did mention it, Kieran. It's continuing a downward trend, and so that tells me there's a sort of reflationary phase coming forward. And I just wondered the extent to which that leads you to move to closer towards emerging markets and commodities as the desirable place to be, whether that's taking it a bit too far.
I'll hand it over to Annika. Andy, that's a very good question, yeah.
Yeah, if you can answer that, Annika, and add the other bits you were going to say anyway. Thank you.
Thank you, Chair. Thank you, Andy. Very, very relevant question. And if you see our tactical portfolio allocation, you would see that there has been a shift to exactly what you said. We have made, in the recent months, an initial emerging market equity allocation and also an additional emerging market debt allocation, dollar weakness being quite an important theme in that overall context. However, when we are looking at currency positioning, we are also considering domestic issues and how Brexit can have an impact on sterling. So that is a very important consideration when we are looking at only the tactical portfolio. Strategically, yes, that is quite important. There are a couple of things. If you see the US 10-year Treasury now, it's around 93 to 95 basis point, much higher than in the start of the pandemic, where it came down almost 40-50 basis point lower. And that is starting to bring in considerations of, when Kieran mentioned cautious optimism, so that is the caution in the overall optimism. So as yield starts going up, you start having some concerns on how equity valuations will start looking like, and also on inflation, because that will also start having an impact on inflation. But on your question on dollar weakness, that seems to be the consensus trade. And there are market participants who have also said that overall dollar index can go down almost 10 to 15%, even from where they are now, which looks quite significant. However, I will just caveat it that whenever there is a consensus trade going on, then something just does not go in the way the consensus believes, and there can always be a turnaround. So that is something to therefore balance the risk weightings that we bring into the portfolio.
Thank you.
Thank you very much for that, both of you. We haven't got any more speakers there.
No. So, Derek,
no,
that's a position where we are on investments and what we feel that the markets may or may not do in the next few months. What I want to do now is hand over to Sean to cover the responsible investment update and the ESG part of the presentation, which is from page 16 onwards, and he'll hopefully pick up the question that came earlier from Jane.
Before you do that, you made a comment about Wiltshire earlier, and I would just remind the committee that Wiltshire over the years have been probably our most consistent performer for the fund. This, as you say, is a bit to do with drawdowns, etc. So, yeah, thank you very much for that.
Thanks, Derek. Yep, if I could turn the committee to page 18, please. I just wanted to give a really quick overview of what I think is a very positive investment which we made over the quarter. We've made the 13% allocation now to Brunel's Global Sustainable Active Equity Fund, which has only just launched, hence why there was a delay between us implementing the new strategy in January and now. Just for everybody's benefit, the managers selected for this portfolio, their kind of mandate is to actively seek exposure to companies who provide solutions to sustainability while also targeting a financial return. One of the positives is the portfolio opened with a significant underweight to the energy sector and also had a carbon intensity significantly lower than its benchmark. So, you know, it's off to a good start in terms of doing what it said it would do. If I could just move you on a couple of pages now to page 21, and that's the internal review we've put together of the Share Action Unison report. For those who aren't aware, as a bit of background, Share Action and Unison did a bit of a project back in 2018 where they looked through local authority pension funds investment strategy statements and gave them a score on what their view was of what represents good ESG practice. I will add that there was no contact with any of the funds as far as I'm aware. We certainly didn't get any contact, so this scoring was put together without seeking further input from ourselves. We received 4 out of 18 on this. A couple of months ago received a query from a member in terms of their concern over this score because they'd been made aware of this report. So we agreed that we would put it together, a bit of an update to just kind of reflect the significant progress we've made over the past 18 months. We've rescored it based on the methodology they put in the paper, and we've come out with 13.5 out of 18, which is an A rating. You can see from the following pages, we've put in there the rationale as to why we think we should get marked for that, and the areas where we've not scored ourselves for it, we've put what we're doing in regard to that. In terms of Jane's question, if committee feel it's a benefit, I can speak to them and ask them if they want to cast their eyes over it. But I will say that this isn't necessarily some recognised framework. It's just their interpretation a couple of years ago of what best ESG practice is. So, I mean, I'll leave that to members to decide whether they want me to go back to them or not. Just quickly touching on the couple where we've not scored ourselves on. I think the main ones really that I wanted to highlight were page 24, which is the specific commitments to reducing coal tar sands holding and reducing oil and gas holdings. Now, we've got a commitment to reduce carbon intensity by 7% year on year. So, indirectly we are doing that, and the fund is going in that direction. We have a low exposure anyway, but we don't have anything specific in our RI policy which states that, which is why we've not scored ourselves on that. And I think a bit of the other points were just in relation to actual member engagement. We've discussed it in the past with committee about it being, a very, very difficult process to undertake. I think we're now getting to that stage, particularly with member self-service, where we can actually look and try and find a way to actually engage with all the members and try and get their views on things. So that's something which is on our work plan for next year, and something we're going to look into next year, which will improve our scoring in that areas. And that's everything really I wanted to cover. So I'm happy to take any questions on that.
Councillor Kirkham, Derek.
Yeah, thanks, Sean. That's great. Just to say, I don't know. Yeah, I take your point. I don't know if it's, and they're not some sort of statutory body or anything. They've just set up their own scoring system, haven't they? I'm just thinking otherwise it could go either way, couldn't it? We could go back to them and say, well, we don't agree with you because we've done all this. We think we're this, and they could say, no, well, we don't, or they could agree with us. But it does, otherwise it does just look a bit like, I know that you've given some very good rationale for each question, but it does look a bit like we're kind of marking our own homework otherwise, if you see what I mean.
Yeah, I mean, my only rationale for including this, as I said, was because there was a member of the fund who had concern that we weren't doing anything. I mean, the score in my mind is almost irrelevant. It's the fact that we do have the processes in place, and we are demonstrating very good practice, as was kind of shown by our awards. So I suppose my comment is, if members of this committee aren't satisfied that what we've provided is enough, or it may not have merit, I'm happy to go back to them, but I'm happy to leave that to people's opinion.
The other thing I picked up from it was just the stuff about the oil and gas and coal and tar. Should we look at that? Should we have some sort of target for that if we don't have a target for that already? Because I did go to the points that you made in your email back to me about the infrastructure, and we do have some holdings. I think it's a Slovakian gas company or something in our infrastructure portfolio. So we could look again at what we hold in oil and gas and coal and tar, maybe. Is that something we could do?
I mean, we did discuss it obviously at the training day when we're putting together the RI policy. It is something that we can look at include the next time we revisit it. I mean, in terms of the holding you've mentioned on the Slovakian gas, by quite a lot of commentators, gas is seen as a kind of a transition fuel.
Yeah.
And from memory, the market where that investment is, I don't think their renewable infrastructure is quite what it is now. So that kind of investment was made, to try and kind of capitalise on that transition by being, where that market is. But in terms of the coal and oil, we can certainly revisit that the next time we're doing the strategy. But as I say, we are effectively doing it anyway with our commitment to reduce carbon intensity by 7% year on year. But yeah, I'm happy to take that the next time we review the strategy with members.
Thanks.
You're on mute, sorry, Derek.
Sorry.
Thank you for that, Sean. And my view on this is quite simple, that I would give a lot of notice to this sort of survey had they fully engaged with us as they were doing and before they did. But as they didn't at all, I give it much less weight anyway. So I'm sorry you had to take your time in putting these rebuttals up and explaining our position. But, it's just one of those unnecessary things we sometimes got to do. So thank you for that. Right. Russ, have we finished with this? And Sean, have you finished with this item?
I think we have, yes. As I say, any feedback on the new reporting format would be, we will see that we can improve that. But obviously, we finished this item. Over to you, Derek.
Thank you. On page 9, we've got the recommendation there. If you all have a look at that, we note the fund's position and the performance of the investment. I'll move that from the chair if someone would kindly second it.
Yeah, I'll second it, Chair.
Thank you, Pete. Okay, Lynn, over to you.
Thank you, Chairman. John Fitter, for, against or abstain?
For.
David Harris?
For.
John Hurd?
For.
Derek Holly?
For.
Sue James?
For.
Joanne McKenny?
For.
Jane Kirkham?
For.
Pete Mitchell?
For.
Oliver Monk?
For.
Andy Stott?
For.
Chris Wilson?
For.
That's unanimous, Chairman.
Thank you very much, Lynn. We move to the next item, which is on page 49, which is the administration part 1. Calvin, can you start us on that, please?
Yeah, certainly, Chair.
Sorry, Chair, before you start, can I come back with a question which I wanted to ask and we didn't get there? Page 36.
Yeah, go on.
It's the question I asked in the training about allocation to infrastructure. And then we have private equity, which in that presentation, private equity was all about infrastructure. Does that mean that we have an allocation to infrastructure and an allocation to infrastructure in private equity?
I think that was a little bit of a misunderstanding.
Yep.
We've got, private markets is the catch-all term. Then, as you know, we've got private equity infrastructure under it. I think the point that he was making in the training was there's two types of infrastructure you can invest in. There's infrastructure equity and infrastructure debt, and they're just two different ways of accessing it. So, equity is where you own some of it. You take on the risks and rewards of owning it. And debt is where you're almost funding the debt. So almost like our private debt, like a bond allocation. So I think that's where you're putting up the capital and just receiving an interest payment, but you don't have any of the ownership of it. So you don't have the kind of risk reward there.
So all our infrastructure investment is actually under the infrastructure umbrella?
Yes, it is. Yeah, it's all infrastructure equity.
Thank you, Sean. Back to Calvin.
Thank you, Chair. Yeah, just a normal admin update, really. Basically, we're still on page 50. There's not a lot of movement with the employers in the fund. We've had St Burren Primary School, which is a small academy set up in its own right. There are only about a dozen members. They've now merged with a larger academy in the fund. Just means we've got one separate, less employer in the fund, but the membership stays the same. On page 51, the active membership movements. I was a little shocked when I seen the numbers come out, because this is it's the very first time that we've had a negative number, whether the actual number of records has gone down. We've subsequently looked into this, and we've discovered, unfortunately, that the council's Oracle payroll system hasn't been providing us with all the people that have in fact joined the LGPS. We were finding a number of people were calling us saying that they wanted to query their membership, and we never had any records of them on our system. We've subsequently had around another 250 starters brought across from Oracle, so that does put us back into the positive area of having more people join than leave. I must admit, we still don't have a lot of confidence in what the council system is kind of giving us with regard to not only people joining the scheme, but people leaving the scheme. So we're working with the council to identify where these errors are and why those errors are happening. And we are getting there, but we're going to embark on an exercise with the council's payroll system to basically go back to April, when Oracle was first brought online, and to check that we do in fact have everybody who says they were in the scheme, that we have their records on our system. And also we're going to check everyone who's left the pension scheme as well, to make sure we know everyone who's actually joined and left. So basically on page 51, at the moment, the information we're holding does still suggest that we've got more people joining the scheme than we've had people who's actually leaving it. Go over the page onto 52. The measures of the admin workload, it's gone up since the previous quarter, which is reflecting the teams getting to grips better with regard to the circumstances that we're working under. One number that particularly jumped out at me, given the current circumstances, was the deaths. We had 12 in the previous quarter, and now we've got 91. What's happened is that there's been a number of outstanding death cases that we've finally got around to dealing with, and therefore there's a significant number in that 91 that related to the previous two quarters. So although it's a large jump, the actual number for the quarter should be around 40 and not 91. The other 50 related to the previous two quarters. So in theory, we've been underselling ourselves in the previous quarter, and we're overselling ourselves here. It got me to think about if the COVID pandemic has affected us in any particular way in the fund. So we've analysed the number of total deaths we've had in the 6-month period from April to September this year, compared to the same period last year in 2019. And to my surprise, the number of deaths is almost the same. So the pandemic hasn't really, say, adversely affected the fund, depends which way you look at it, but we haven't had a significant number of extra deaths because of the COVID. The number of pending cases has gone up. The biggest jump is the leavers, which the regulator has said that he's quite happy for us to leave. He's given us a priority of dealing with people who retire and deaths as well. So they are beginning to stockpile slightly, although there are around 400 to 500 of those pending cases where we have sent members options to deal with their benefits, but they haven't answered us yet. So although there are a number of cases that are pending, they're pending because we're waiting for the member to come back and make the choice, as opposed to us having to do the actual work. So it's not as bad as it possibly looks. I'm pleased to say. Over the page, that's the newsletters that we've been sending out. We regularly send an employer newsletter every month to keep them up to date with what's going on. This time there are a couple of newsletters that went to our members, the active membership and the pre-reserved members. Those newsletters went out when we sent the annual benefit statements out a couple of months ago. When we send the statements out, we always send a newsletter with them. So that's why there's newsletters on there this time for the membership as opposed to just the employers. On to the death grants. Usual amount that we paid out, just over £300,000.
Yes. The active members' newsletters are really good. Thank you for them. They're very, very clearly put out, and I think they must be quite useful for those people. So thank you to whoever does it, you or whoever. Thank you.
Okay, thank you, Chairman. On the death grants, I'm pleased to say that for a change, most of the death grants were paid in accordance with an expression of wish form that an employee completed, which makes my job and your job, Chairman, somewhat easier when we do have something as simple and straightforward to pay out, as opposed to having no form at all or the form being out of date. So that was a pleasant change for us in the last quarter. Onto the risk register on page 103, I've added a new risk, ANC 12. We're going to cover the exit payment in detail in part 2, but it is going to be a major task for us in the admin team. There are going to be software costs because our software is going to have some major changes to it to accommodate the proposed changes that the government are going to make to the pension scheme. In addition to that, until those software changes are incorporated, which will probably be over 6 to 9 months, I expect, we will have to do manual calcs to determine the strain costs that employers have to pay when they make someone redundant or a leave under efficiency terms, to calculate the cost the employer's got to pay into the fund to cover us paying an unreduced pension when we would normally reduce it for going early. So there's going to be some extra work, unfortunately, for my team to calculate those costs. Fortunately, our actuaries, Hymans Robertson, has given us a spreadsheet that we can use to calculate the cost of the strain payment, but it still means that my team have to manually input the data to get the numbers out, whereas at the moment the software automatically calculates those costs for us, so we haven't got anything to actually do. So that's going to increase the workload for the pensions team. certainly in the interim period. We got around to sending the annual benefit statements out. They were about 6 weeks late. The regulator was informed. He wanted to know when we did post them. I informed the regulator 2 days after they were posted. I'm pleased to say that the regulator came back and was happy that we sent them out within 6 weeks of the actual date we should have sent them, and that they were going to take no further action against the fund. We did notice that the day that the benefit statements landed on people's doorsteps, there was a certain change in working conditions because primarily everyone's working at home. And I think in the 24-hour period when they did land on people's doorsteps, I think we had around 300 emails come into the office raising queries on various aspects of the statement. So that just showed there was a lot of people working at home when we don't normally get that large volume of emails all at one time. At least it shows they're reading the statements we send out, Chairman. So that is one way of looking at it. Data quality scores. The regulator requires us now, as in all defined benefit schemes, to measure the quality of the data that they're holding on the systems. We do this on an annual basis. There's two measurements the regulator likes us to look at: is common data and conditional data. The common data is precisely what it says on the tin. It's the data that everyone has: name, sex, and number, date of birth. The conditional data relates to the specifics of the pension fund. So for a defined benefit scheme like the LGPS, they're looking to make sure we've got membership details, like details of salary, career average earnings, they transfers in, etc., etc. So there's quite a lot that they check on those areas. I'm pleased to say that the measurements for the current year are almost identical to the ones in the previous year, which is good to know considering the circumstances that we've been working over the last 5 or 6 months, primarily at home. And in addition to that, there was another additional 3,000 records that were being added to our database this year compared to last year. So we're looking at the high 90% accuracy on our data, which is exceedingly good, I think.
It's very good.
And that, Chairman, is where I've finished my report, and I'm happy to take questions.
We've got a few questions.
Chairman, it's Russell. Can I just come in there quickly before you take the
Okay, Russ, keep going.
Questions? Yeah, just come in at the back of Calvin presentation then. I just wanted really to pick up on the annual benefit statements. On a number of sort of statutory deadlines that the council has had to deliver during the pandemic, there have been dispensations given. There wasn't on this one for some reason, that we still had the 30th of September. The fact that we didn't achieve it, but we achieved it within 6 weeks of that statutory deadline, I think, although on the face of it, it looks like we've missed the target, I think it was an exceptional piece of work. I think it goes to show that we've had to adapt over the period with the COVID pandemic. We've had to look back on, how do our business continuity plans work? And I think we've had a steer from the regulator to ensure that pensions were paid accurately, etc., during that period, and the pensioners weren't adversely impacted. And to still deliver those only slightly late, I think is in a completely different environment we've ever worked in before. I think, rather than looking at it as a negative, I'd like to think that committee would look at it as a positive, that we've managed to deliver that, albeit late, but it isn't horrendously late, and it's been done in very difficult circumstances. Thank you.
Very good point, Russ, and the regulator would have picked this up if it had been anything other than that. So thank you for that, the team as well. Is it Joanna first?
It was David Harris, sorry, Chair.
Okay, sorry, David Harris. David?
Thank you, Chair. A couple of points. I have to say, one of the nice things about being on this committee is the efficiency of the administration system. I mean, it really is to be admired. And then having so how efficient that is, This Oracle mess, a project that went millions over budget in the council. Simple question on this: is it a mess because the Oracle system itself has got a problem, or is it a mess because the people inputting the information into it haven't been properly trained or guided on how to deal with it?
I think it's a bit of both. We tend to find when new systems are first brought in is that employees are trained on inputting data, but they do tend to find shortcuts as they get more experience with it, and they don't necessarily understand the circumstances of taking shortcuts. And if certain fields are not completed or completed correctly, then it has a knock-on effect to other areas that they don't know anything about. So that's part of it. And the other issue is that I think there is a problem with Oracle because they're not, even though some data is input correctly, they are not identifying all of the cases that they should do, or indeed they are identifying cases that they think are new entrants to the pension scheme when in fact they're not. So for instance, if someone goes on to kind of zero pay because they're off sick or for various reasons, and then 2 or 3 months later they come back to work and start earning money, the system thinks that, well, they didn't pay contributions last month, but they paid this month, so they must be a new member to the pension scheme, when in fact they've probably been in the scheme for years. And these are the sorts of things that we're picking up from the Oracle system. It's the problem is that new starters, if they give us a new starter we've already got, we can pick it up and we can go back to them and say, well, this isn't a new starter, and why are you telling us they've just joined the pension scheme when they've been in for several years? Some of the major problems are where they don't tell us that someone's joined, because as you know, we administer the scheme for over 100 employers, and we don't know if employers are taking people on or if indeed people are leaving until the employer tells us. And quite often it's getting almost embarrassing in some cases where employees are contacting us and say, well, I left this employer 6 weeks ago and you haven't written to me, and say, well, we haven't been told you've left. And conversely, where people are contacting us and say, well, I've been in the pension scheme for 2 months and I want to opt out, and we say, well, we don't even know you've joined. So it's a bit of both, basically, inputting data and trying to extract the correct data that we need. Like I said, we are working with them to try and tell them the errors that we're finding and trying to help them to correct those errors, but it's a very slow process.
Thank you. Can I just ask you for one of your big risks is the McLeod judgment. Are we any further forward with the remedy for that?
No, the government consulted on the remedy for McLeod 2 or 3 months ago. Everyone's put their comments back to the government as to how we think they should remedy what's happened. We think it's a foregone conclusion because there's not a lot they can actually do about it, but we're kind of waiting for the government to confirm how they intend to resolve the issue. We have had our actuary advisors, Hymans, do an initial sweep of our data, the membership data, to identify people or members who they think could be impacted by this change in law. And quite frighteningly, they've come up initially with nearly 15,000 of our members who could be implemented. Now, this is potentially sledgehammer to crack a nut, I think, because there's going to be a lot of cost and effort involved for very little output, because it's going to be difficult for, I think, the underpin of comparing a 60th accrual with a 49th accrual. Someone's going to have some pretty hefty salary increases for a 60th accrual to beat a 49th care accrual. We've yet to dig down any further into how this is going to be affected to it and how we actually manage it, to be honest, David. But with everything else going on at the moment, McLeod's not the top of my list to actually look at, and they're not looking at a remedy to be implemented until 2022 because they think the transition period is going to be from 2012 to 2022. I have got it is on the list, but at the moment with everything else going on, it's not the top of my list.
Right, thank you.
Thank you very much. Who's next?
Chris Wilson, Derek.
Oh, Chris. Are you there?
Hi, yeah, thank you, Derek. I was just going to say to Calvin, as an employer also using the council's Oracle system, we've experienced some glitches ourselves with people not being paid, which has caused a little bit of embarrassment. Because it's the most important thing that we've got to get right is pay the right people on time, the right amount of money. And as an employer, I would be happy for you to ask us to do some of the audit work to ensure that the people you've got on the pension match those that we are paying for. So
okay. Thank you, Chris.
I think all employers would be happy to do that. It's absolutely critical that we get this right, because some people will be paying into the scheme for 20, 30, 40 years. And if it isn't right now and you're having to unpick it in all that time ahead, it's just a nightmare.
Oh, thank you. Yep, sure.
Chris, thank you. Who's next?
Andy Stott, Chair. Andy Stott, Chair.
Yeah. Calvin, in relation to the risk register and discretionary severance payments, I gather they're changing the consultation for the exit cap. This is slightly separate from the exit cap issues that we're going to discuss later on in the agenda. But I understood that the discretionary severance was 1.25 times statutory or something like that. It appears to be moving towards a maximum of 3 weeks per year of service, up to a maximum of 15 months pay. Is there a change coming through on discretionary severance, and is this going to add to your burdens of changes that you have to implement?
Yeah, the government are consulting as part of the exit regulations to amend the compensation regulations, but that is primarily, Andy, to do with an employer issue. It's the discretionary redundancy payment that an employer is able to pay to an employee when they leave. As you're probably aware, there is a table for calculating the number of weeks pay that an employee is entitled to based on their age and service. And there is a cap on the amount of weekly pay that that an employer can use. I think it's £538 is a cap that the employer can set by statute to say, well, under a statutory basis, we haven't got to account for anything over £538 a week. The compensation payment allows you to, certainly at the moment, pay up to 104 weeks pay, and there's no limit on the amount of pay you can use. But those compensation regulations, Andy, are relating to employer payments only and have no real impact on the pension side.
Thank you. Yeah.
Okay. In that case, there's no other questions come up as far as I can see, and I'm going to move on page 49 to the recommendation that we note this administration update. I'll propose in the chair. Can I have a seconder, please?
Yeah, I'll send it, Eric.
Okay, then I think I was Pete again. Lynn?
Thank you, Chairman. John Fitter, for, against or abstain.
4.
David Harris.
4.
John Hurd.
4.
Derek Holly.
4.
Sue James.
4.
Joanna Kenny.
4.
Jane Kirkham.
4.
Pete Mitchell.
4.
Oliver Monk. Councillor Monk. I'll come back. Andy Stott.
4.
Chris Wilson.
4.
Councillor Monk.
4.
Thank you. That's unanimous, Chairman.
Thank you. It's now 11:16. If we can have about 8 or 9 minutes break, back by 25 past, we'll have but I think it will stay live, so Just mute everything, please.
It will stay live, Chairman. So cameras and microphones off, everybody, please.
25 past 11. Okay, 11:25. Thank you.
Thank you.
Hi, Lynn.
Oh, Derek.
Hello.
Hiya. Can I just I'll put that video on as well. Can I just say that if we happen to run up to 1:30, I'll have to leave the meeting.
Okay.
We're a bit light on the staff for duty.
Yeah. Okay. Thank you for that.
All right.
Thank you. Oh, Chris, when you leave, can you just put a note in the chat box, please? Thank you.
Yes, of course.
Thank you. Right, who have we got, Lynn? Who's missing? Oh, it's a difficult question. Okay, who's not here? Who's not here? Jane, Amanda, the back, John, Joanna, Sue. Lynn, are you there?
I am. Sorry, I'm talking to you, but I'm on mute. I didn't realise. Beg your pardon.
Thank you. Just want to check that everyone's here. I think most people are here. I just
haven't seen John Hurd yet.
I'm here.
Oh, lovely. Thank you. Shall I do a quick roll call?
Good idea. Yes, please.
Yeah, let's do that. John Fitter.
Here.
David Harris. John Hurd.
Yeah, here.
Thank you,
Here.
David. Thank you. Derek Colley. Well, obviously you're here. Sue James. Joanna Kelly.
Yep.
Jane Kirkham.
Yep, I'm here.
Pete Mitchell. Pete. You're on mute, Pete. Pete, you're on mute. Perhaps not back yet. Oliver?
Yeah.
Andy?
Yes.
And Chris, we've spoken to.
Yeah.
Thank you.
So it's just Pete, is it?
Just Pete at the moment.
It's not bad. Only 2 minutes past. We've been far worse than that in the past. Pete, you there yet?
Yes, Derek, sorry.
Yeah, thank you. We're all here.
All here now.
Thank you. Thank you, everybody. We'll proceed. We're on page 93 with the governance report, part 1. Sean, can you take us through that, please?
Yeah, sure thing, Derek. This should hopefully just be a brief update. If I could just turn the committee to page 98, please. That just really contains the summary of this item. The only new risk to the risk register is the ANC 12, which is the impact of the exit cap regulations, which Calvin covered in his previous update. The only other thing attached to this paper, just for committee's awareness, is the pensions committee pension board minutes, sorry. And that's it really. I'd just like to open it if there are any questions, please.
Are there any questions? There being no questions.
Not that I can see, sorry.
Okay, thank you. We'll move into the second part, which is the exclusion of the press and public, and I have a statement to read, I'm afraid. It won't take long.
Do we need to take a vote on that?
We will, Chairman. We'll need to propose the
Sorry, yes, thank you.
governance update. And
I'll do that, and Pete, will you second, or somebody else?
I certainly will.
Thank you. Lynn, can you?
Yes, I will. John
Yeah.
Fitter. For,
Approve.
against, or abstain. Thank you. David Harris.
For.
John Hurd.
For.
Derek Holly.
For.
Sue James.
For.
Joanna Kenny.
For.
Jane Kirkham.
For.
Pete Mitchell.
For.
Oliver Monk.
For.
Andy Stott.
For.
And Chris Wilson.
For.
Thank you. That's unanimous, Chairman.
Thank you. Pensions Committee, exclusion of the press and public, is proposed under section 100A brackets 4 of the Local Government Act 1972 as amended. The public be excluded from the meeting for the following item of business on the grounds it involves the likely disclosure of exempt information as defined in paragraph 3 of part 1 of schedule 12A of the Act, namely information relating to the financial or business affairs of any particular person, brackets including the authority holding information, and that proceedings apart from resolution shall remain confidential. Lynn?
Could we have a proposer, Chairman, please?
Yes, I'll propose. Second, please.
I'll second it.
Thank you very much.
Who was that, please?
Pete, that was Pete.
Thank you. So going through, John Fitter, for, against, or abstain.
For.
David Harris.
For.
John Hurd.
For.
Derek Holly.
For.
Sue James.
For.
Joanna Kenny.
For.
Jane Kirkham.
For.
Pete Mitchell.
For.
Oliver Monk.
For.
Andy Stott, excuse me.
For.
I'm Chris Wilson.
For.
That's unanimous, Chairman.
Okay, thank you. We're in part 2.
We just need to arrange for the live stream to be switched off, Chairman. Sorry to interrupt. I'll just ask if we can arrange that, please.
Sarah Goodall, meeting producer here. Yes, I'll contact the live stream operator and ask them to stop.
Thank you. Committee can get ready, the committee on page 113. I'm going to say to Katie and Amanda from the board, please be welcome to join in and question anything you want.
Thank you, David. I'm finding it incredibly interesting.
Thank you.
Yeah. But I don't have any questions at the moment.
Yeah, just jump in like any other committee member. Okay.
Okay.
Sorry, Chairman. Sarah Goodall, meeting producer here. Chairman, do you intend to go back into part 1 after consideration of the part 2, or can we terminate the live stream?
No, I don't intend to go into part 1.
That's great. We'll terminate the live stream. Just 1 second, Chairman.
Thank you.